This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Stocks look frothy and gold has gone parabolic. But does what is going up have to come down? Up next, how should we think about fundamentals, valuations, and how much room is left for error? Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Lots to get to today. Stock market, of course, continues to trade well, and gold has gone parabolic just here in the last couple of months. So I don't often talk about precious metals, but gold's been in the news so much that I feel it deserves some attention. So we'll get to that. But again, we're continuing one of the most remarkable comebacks in history. The S&P has now rallied just shy of 40% off the April lows, hitting something like, I think it's 33 now, all-time highs along the way. Strategists put this in some historical context. It's about 6 months, right? It's about 6 months off the lows. And since 1950, this is the fourth best performance of all time, coming off a more than 15% drawdown. And it's some pretty good company. The first, second, and third on the list are 2020, 2009, and the 1982 lows. And importantly, the reason I bring this up is because success tends to breed success. With this type of performance off of a low, generally speaking, once we're at the 6-month mark, the next 65 days after that are positive on average, like almost 90% of the time, to the tune of 7.7% return. And then the next 125 days after that, also positive, almost 100% of the time. Again, this is going back to 1950 with an average return of 10.2%. So past performance is no guarantee of future success, but history says that what goes up does not necessarily have to come down. And by the way, if you kind of consider stocks and gold together, strategists noted that when S&P and gold are in the 90th percentile of 6-month performance, like they have been over the last 6 months, this is again going back, I think, to 1975, the odds are that stocks do well in the ensuing 2 months, up 6.6% on average, and going out 6 months, almost 10.3%. Meanwhile, gold, not so much. Gold, you've tended to see a correction over those same time periods. So I just say this because I think a lot of people are fearing success, right? A lot of people are fearing that the market has to come down. And I will talk about how the margin for error is thin and how we could get a correction at any time. But just because the market has been trading well does not mean you should somehow get super bearish, in my opinion. Okay, not to mention seasonality is about to kick in. If you, again, go back to 1950, starting around mid-October, okay, this has been the best 3-month period of the year on average. There have been a couple exceptions to that, but generally when the underlying trend was already negative, like we were in recession or already mired in a bear market. But when backdrop is neutral to positive, like it has been, odds are that this is a pretty good period going forward. And, as I've said several times, we've been in a bull market, I think it's fair to say, since the lows in October of 2022, right? So we're about 3 years in. Since 1932, according to my math, the average bull market has run closer to 4.5 years, with a much stronger move, by the way, than what we've seen so far. And by the way, the last 12 months of the average bull market since 1932 has seen gains of close to 30% in the S&P 500. So, bull markets tend to go out with a bang, not so much a whimper. So we'll see, how that looks going forward. I also noted, I think it was just this week, maybe it was late last week, but regardless, the 38th anniversary of the 1987 stock crash for you old-timers who've been around for a while. Of course, that was a complete wipeout, right? Market lost over 20% in one day. Do you know what the return on the S&P has been since that event? 5,600%. 5,600% return since that time, which works out to an annualized gain of about 11.3%. With something like 772 new record highs. This is data according to FactSet. So you know what I'm going to say, right? Don't panic in crashes. And I know 1987 was a long time ago, but you can look at the returns coming out of virtually every crash since then, right? Whether it was .com, great financial crisis, COVID, or just what we had in the spring. The data says don't panic. Meanwhile, by the way, over the past 30 years, also according to FactSet, the U.S. Consumer Dollar Index has been cut in half due to inflation. Over the same 30 years, S&P up 8% a year. So what does that tell you? If you're just sitting in cash, your purchasing power has likely been eroded dramatically. But over the last 30 years, of course, you stayed afloat if you've been invested. So I'll leave it at that. But this doesn't mean that we cannot have a pullback. We saw a pretty violent day. I think it was a couple Fridays ago, right? The S&P went down almost 3%, which spooked some people. Ended up being kind of a one-day event, but still, don't forget that we can have a correction at any time for any reason. You know, there's that famous JP Morgan chart that I've referenced before that shows the average intra-year drawdown going back to 1950 in the S&P is 14%. And many of those years where we've seen that type of drop or more has come in good years where the market's still been positive. So being a bull does not mean you think the stock market will only go up, because it often falls and fails multiple times on the way up. You know, the folks up at Ritzold Asset Management noted just this week that roughly 12% of all trading days in a given year see a loss of 1% or more. Again, this is going back to 1950. And there's been a 5% correction roughly once a year on average, and a double-digit decline roughly every 2 to 3 years on average. And of course, we had a double-digit decline in April. So the fact that history suggests and precedent suggests that the markets could and maybe should be higher over the next 6 to 12 months does not mean that it's going to be a smooth ride. That's all I'm saying, all right? And obviously, we're here to hopefully help figure out, you know, what's a short-term event from what's a more sustainable downturn. We'll see. I think one of the things that I noticed this week, by the way, and this is not really, I don't know if this is anything that you really need to pay too much attention to, at least our listeners, but I noted the proliferation of speculation in terms of what type of investments are coming to market. So this is from Strategas. They noted that over the last 6 months, 1 out of every 4 new exchange-traded funds, ETFs, that have been launched, 1 out of 4 is a leveraged fund. And by leverage, meaning they are making leveraged bets on the direction of an asset class or even an individual stock. So they have these funds right now that, you know, pick any prominent stock. And I'm not going to get into any specific funds this morning. But if you look at Netflix or, you know, any big stock, there are funds out there that could give you 2, 3, 4 times leverage to that individual name. And in fact, just last Friday, 70 new funds targeting 3 times exposure to an individual stock were filed for with the SEC. The only reason I bring this up is this is why you have and could have pretty sharp, you know, negative reaction days, right? If one of these big stocks comes out and misses their earnings and goes down, you know, would have gone down 5% normally, well, maybe it's 10 or 15 or 20%, given the leverage of everyone's heading to the exits at the same time. Same thing happens at the market level. So just be prepared for violent intervals, if you will, because of all the leverage out there that may or may not be suggestive of a more protracted risk event. Okay? The other thing I kind of noticed that, you know, and I say this because the markets overall, to me, do not feel like a bubble, but there are pockets of frothiness, and certainly the leverage in the ETFs is part of it. The other part of it is, you know, Apollo came out this week, Torsten Slok, their chief market strategist, and noted that companies with negative earnings in recent months have outperformed stock prices of companies with positive earnings. And he was talking specifically about the Russell 2000, which is the small cap index. But this is something that we've been talking about for some time, that quote unquote high quality stocks, companies with solid balance sheets, earnings, revenues, have not necessarily outperformed. And the same thing goes if you look at valuations. According to FactSet, if you look at the S&P 1500, which by definition is a pretty broad index, and if you look at what sort of quintile of valuation has done the best this year, far and away the highest quintile. In fact, the best performing stocks here in 2025 as of last Friday are those trading greater than 10 times price to sales, which is a pretty astronomical valuation. So you could say that maybe that's because of AI and the promise of AI. It also just speaks to speculation, right? Just speaks to speculation. So you've got to be very careful with that going forward. And then, of course, and I've talked about this ad nauseum over the last year, concentration. I mean, you have to think about concentration as a risk. NVIDIA now makes up 8% of the S&P, and as of 3 days ago, NVIDIA, Microsoft, and Apple combined now make up about 22% of the S&P. 22% in 3 stocks. That's the highest weighting for any 3 stocks in the index on record. I'm not necessarily saying that's a bad thing, by the way. But it is something for you to note, because I hear every day, I just want to stay diversified and own the S&P. Got news for you. The S&P isn't diversified. It's not. It's not a diversified investment. Now, if you balance that with a value index or international or small cap, bonds, cash, commodities, yeah, okay. I can buy the fact that you're diversified. But if you're sitting there with all your money in the S&P 500, you are not diversified. In fact, the vast majority of your performance, exposure, risk is attributable to literally a handful of companies. So I'm not trying to scare you. I'm just saying keep that in mind in your thinking. And I would argue, and this is not just to, sing from my own hymn book here, but if you are more selective in terms of what you own, and maybe the exposures in your portfolio do not completely track the S&P. Maybe you own some individual names in healthcare and energy and financials and industrials, and you've spread things out a bit. I would argue that could potentially, and I say potentially, as long as you're diversified enough, potentially be a less risky approach than owning the index. So just keep that in mind. Just a funny little kind of factoid also from Apollo. Mr. Slock over there noted that the average U.S. worker contributes $8,500 a year to their 401k. And about 71% of that goes to stocks. So by his math, if you look at the weight of almost 40% in the S&P in most people's portfolios, that means the average worker in the U.S. is putting $2,300 a year into the Magnificent Seven, regardless of whether their outlook is good or bad. It's kind of funny, right? So just something. And by the way, I don't want to belabor the point here, but just to give you some more statistics around this. If you look at the Magnificent Seven, J.P. Morgan noted that so far this year, just a little shy of half the return in the S&P has come from those 7 stocks. Last year it was 55%. 2023, it was 63%. And by the way, 2022, and I note 22 specifically because it was a negative year, 56% of the negative performance came from those 7 stocks or was attributable to those 7 stocks. So, you've got to take the good with the bad. Concentration obviously is a good thing when things are going well, like the last 3 years, but it could get ugly really quickly. And we saw a small dose of that, I should say, in April when, stocks like NVIDIA were down 40% in just a few weeks. So I'm not making a comment really on whether you should or shouldn't be concentrated in these names or concentrated in the S&P. I just want you to be aware of it when you're thinking about your risk profile. That's all, okay? And by the way, I talked about how the average bull markets run 4.3 years. This could go on for a while. Since the low in March of 2020, the NASDAQ, which is where a lot of the tech stocks trade, is up about 200%. Well, during the tech bubble of the early 2000s, The index went up closer to 400%. Similar patterns were seen in Japan during the 1980s, China in the late 2000s. So if you think these are market excesses in tech and AI, well, they can persist a lot longer than this. And I will also tell you that valuations, I don't think, yes, they're pricey, they're expensive, but I don't think they're going to be the trigger to tell you when to get in or when to get out. In fact, if you look at all the bear markets since 1980, some started at high PE ratios, some didn't. I was just looking here, and this is according to FactSet. The market peak in 1998, market was trading at 23 times. Okay, that's pretty pricey. But the market peak in 2011, only 13 times. 2018 peak, only 17 times. So, valuations can be a symptom or a contributor to a bear market. But just because stocks are expensive really does not provide any indication that the market's, the bubble, quote unquote, is about to pop. And by the way, there's been an endless cacophony of bubble chatter. I've been doing this since early 90s. I cannot recall ever hearing the crowd identify a bubble in real time. In other words, if everyone's talking about a bubble, I find it very hard to believe that everyone's going to be right in predicting that. Now, again, the old expression, just because everyone has an umbrella doesn't mean it isn't raining. But generally speaking, the crowd is not right. Okay? So, I don't know. I'd also note, by the way, if you look kind of at the broader market, the ratio of U.S. large cap performance to U.S. small cap performance as of about a month ago hit the highest level seen since 1999. That's rectified a little bit recently as small caps have picked up, but it's still pretty extreme. Same thing if you look at the ratio of growth stocks to value stocks. Hit a new all-time high, surpassing the dot-com bubble peak back in March of 2000. This is from Charlie Bolello, who I follow pretty closely. So even though we are seeing some frothy activity in pockets of the market, there are a lot of pockets of the market that are not frothy, that are actually outright negative for the year, including a lot of the denizens of the value index. So I do think there is some opportunity here if you are willing to be disciplined and selective. The last thing I'll say on that front, the sentiment, I follow consumer and investor sentiment pretty darn carefully. It is not, certainly we're not at levels that suggest that everyone's negative on the markets, but we are not seeing sentiment levels, whether you look at put-call ratios, whether you look at Investors Intelligence, American Association of Individual Investors, you are not seeing the types of levels that you normally see when, people are fat and happy or where there's worries of kind of excessive exuberance or irrational exuberance. We're not there. So just wanted to kind of frame that landscape. I'll just mention briefly, we are, of course, in the early stages of third quarter earnings reporting season. One thing I've kind of noted just as kind of a cautionary thing is that, better than expected earnings has sort of lost its meaning a little bit. I was reading something from JP Morgan. They noted that in every single quarter since 2006, no less than 60% of S&P 500 companies have beat earnings expectations. And so far this quarter, according to FactSet, and this is as of Thursday, 78% are beating estimates. So as Morgan Housel has said, when a company reports poor earnings, it's often said that they miss analyst estimates. But earnings don't miss estimates. Estimates miss earnings. Take it with a grain of salt, folks. I think it's much more important to look at sort of the story behind the beat or the miss, right? I mean, if a company is crushing it, missing their earnings by a penny, does that mean all of a sudden it's a bad stock? Of course, the opposite is true. Very important to look at the trend of the company, what they're saying, the forecast going forward. Often that might give you a different read, and I would argue a better read than sort of the knee-jerk 1 or 2 day reaction to those earnings reports. Plenty of times we've seen a stock sell off 10% on earnings, and it's ended up being a great buying opportunity if you're willing to be patient and have a time frame of longer than a few weeks or a few months, quite frankly. In fact, I would argue some of the biggest winners we've ever had in our client portfolios are ones where we've had an entry point on, an earnings miss, but the underlying fundamentals, were pretty strong. The thing that I will say is, and I've said this for the last, 3 or 4 months, I think the main reason this market has done as well as it has off of the April lows is that corporate earnings have been a lot more resilient than people thought. It's very rare, by the way, for the third and fourth quarter earnings for estimates to actually be going up. Usually they start high and come down over the course of the year. But here we are, as recently as the end of July, analysts thought that, maybe we would get 7 to 7.5% third quarter earnings growth in aggregate. Now estimates are well over 8%. Again, this is FactSet. So we are seeing upward momentum in terms of earnings forecasts, and that is what's carrying this market. I'm going to be paying a lot of attention to the reports here over the next couple of weeks because I think in the second quarter, investors gave management a little bit of a pass. There was so much uncertainty with tariffs. There maybe wasn't as much scrutiny over earnings as there usually is. But now I think people are really starting to dial in on how our companies managing supply chains, tariff costs, what have you. And what we're seeing so far is companies are doing a lot of different things to navigate tariffs. There's a mix of cost absorption, supply chain shifts, price hikes. Some companies are just leaning on higher volume sales and not worried as much about the bottom line. So I think it's very important, and this is something, of course, that we do for a living, very important to understand the story behind the numbers. How are, not just what are companies doing and what they're putting out in a press release, but how are they doing it? And is it a sustainable strategy going forward? Last thing I'll just say is, still looks to me like companies are in the early stages of AI adoption, and that's being borne out in the numbers. I mean, in the most recent earnings season, only 60% of companies, this is the second quarter, only 60% of companies, according to FactSet, mentioned AI at all on their earnings calls. And meanwhile, what we do know is that broader-based economic growth has outstripped various measures of employment growth. So that indicates to me that we're seeing growth in labor productivity. Companies are getting more from less. So as AI becomes more adopted, this is just my opinion, I think that's going to feed more economic growth, which in turn can support higher profit margins and valuation multiples. So I don't think it's just a situation where, the market's crazy. The market's just about AI. There is a real earnings story here and maybe a sustainable earnings story. And keep in mind, there's some operating leverage here too. If you can get your bottom line earnings and productivity up, if you do get some top line revenue increase opportunities like an expanding overall economy, right, you could see those earnings accelerate. So certainly that would be the best case scenario when you have stretched valuations, is for earnings to actually outperform estimates. Then maybe the market doesn't look quite as expensive as it is today. Maybe this is an overly optimistic take on it, but I just want you to keep it in mind because I think people are only looking at sort of the negative side of this, that, what goes up has to come down. All right, I'll leave it there. I do want to talk for a few minutes about gold. And full disclosure, we don't own a lot of gold in our portfolios. We do have some clients that own gold, for sure. But sort of in general, across our client base, we don't have really any to speak of. And that's probably a bit of a miss over the last few months because gold has done so exceptionally well. So I'm just being honest about it. In fact, gold's on pace as of this week to have its best year since 1979. And the flows have gone, just looking at the flows into funds that own gold, they've gone parabolic. We saw just the other day, I guess it was maybe Monday or Tuesday, you saw over $10 billion come into gold funds, specifically ETFs, in one day. That's only happened a few times in history. Gold's also the most extended it's been in a long time. And if you're a trader, and I'm not a trader, but if you look at like the 200-day moving average, which is sort of a intermediate measure of momentum, Gold is the most extended above its 200-day moving average going back to 2006. This is from Alfonso de Pablos. He's a trader that I follow. And we've only seen that happen a few times. And every time it has happened, according to him, in the past 25 years, we've seen a pullback. I was reading a survey from Bank of America. They do a fund manager survey, which is a weekly poll of global portfolio managers. In the most recent week, institutional investors now see long gold, positive gold, as the most crowded trade of any trade, overtaking the what had been the most crowded trade, the Mag 7 trade. So, gold has done well, but it looks off the charts from multiple perspectives in terms of maybe being a little detached from reality, right? In fact, it's never been pricier today relative to inflation. In 1980, I think gold was about 9 times inflation. Going back, this is from FactSet. Today it's about 13 times. So some pretty heady stuff. But just to give you just a little bit of perspective here, nobody really knows what drives gold. Okay, I think that's something, if you ask somebody in the street, they're probably going to tell you inflation. Inflation expectations drive gold. And that has been the case at various points. I think some people noted that in the early Obama years, that was, coming out of the financial crisis, a lot of people were, I guess probably folks on the right side of the aisle, right side of the political spectrum, I think, considered Obama's policies to be inflationary. And at that time, not only, gold was going up, but gold relative to inflation was going up. But then, kind of went the other way. After, a little bit later, after the financial crisis, those recovery years, a lot of people argued the opposite, that a sharp fall in the real rate of interest, i.e. interest rate minus expected inflation due to the bursting of the housing bubble and the economy's deep recession, that was the reason why gold was going higher. So it was both, in the course of less than 5 years, some people were saying it was inflation, some people were saying it was deflation. That was the driving factor behind gold. Very mixed, but I will say, in general, I think it's fair to say that higher real rates, which again is interest rates relative to inflation, that creates a higher, for you economists out there, a higher opportunity cost to hold non-interest-bearing assets like gold. Okay, and that was evident, I think, the latter half of the 2000s and 2010s, where lower real rates were synonymous with higher gold prices. But I bring this up because the script has definitely flipped. Definitely flipped. In fact, right now in the current environment, gold has been surging with real rates up, not down. So what's going on? Well, I don't know the answer any more than you do, but my guess is gold's moving on more macro concerns, geopolitical risk. Because who's buying all the gold right now? It's central banks. It's pretty clear that a lot of foreign central banks are diversifying away from treasuries, away from the U.S. dollar. And some of it, might be the messy war in the Middle East, might be Russia's never-ending campaign in Ukraine, might be, saber-rattling with China. Who knows? But I do think it is fair to say that there is a real concern about U.S., and I'm not necessarily blaming Trump, but it is what it is. There's concern about the direction that our country is taking in terms of tariff policy and, America first and what have you. And again, I'm not putting a value judgment on that one way or another. I'm just saying that has to be, in my opinion, the reason why you're seeing gold being bought up the way it is. I don't think you can attribute it to inflation expectations because those relationships have broken down. So that's kind of the why, but you may not care about the why, but if you do put it in some context, there's a reason why we're not that excited about owning gold. You're not always going to catch the hot dot. I look at the last 30 years, there are plenty of times where the asset class that's the hottest at the time, we don't have a lot of exposure to in our portfolios, and I'm okay with that because the vast majority of the time, those trades burn out, peter out, and the people that do buy into those things are buying them in the fourth, fifth, maybe eighth inning, and probably more set up for failure than success. So I don't mind missing some of the hot dot. And I think history supports that. History supports that. I mean, just kind of walk you through it a little bit. Of course, gold did well in the 70s. We all know that, particularly when Nixon ended the Bretton Woods system that pegged gold to the dollar. But then things got pretty ugly for a while. We saw a big reversal in the 1980s as stocks did great and gold got crushed. That continued in the 90s, right? That crush. Gold actually had a maximum drawdown of 70% and a negative return for about 20 years. 20 years. And on an inflation-adjusted basis, gold did not pass the high from the early 1980s until, get this, last year. Last year. And remember, this is from FactSet, by the way. They helped me with some historical data. And then just when everyone had given up on gold, there was a lost decade. Then gold shined again, and it proved to be a pretty good hedge during the global financial crisis during that decade. I think the advent of gold as an ETF, where it was a lot easier to trade, that probably helped, right? You didn't have to own coins and bullion. You could just hold an index. But again, if you look at it, going back over a longer period of time, it's still the long-term numbers are pretty darn anemic. I mean, so for one, you've had 3 out of the past 4 decades produced negative returns for gold. 3 out of the last 4. And then from 1980 through 2019, stocks did about 8,200% return, 8,200% return. Gold only did 197% return. Okay? You're looking at annual returns of only 2.8% versus 11.7% for the S&P over 40 years. 40 years. The worst 40-year return for the stock market, going back to 1928, is 8.5%, almost 4 times higher. So, again, I just want you to consider the history a little bit. I'm not saying don't own gold. If you've owned gold this year, God bless you. You're doing great. That's awesome. And I support that, and we certainly have clients that own gold, like I said earlier. But it's really hard for me to get that excited about an index that has such a poor long-term return. And if you're wrong about gold, by the way, one, you can be wrong for a long time, right? We've seen 10, 15, 20-year periods of underperformance, but you're also not getting paid anything. If I'm wrong on a dividend stock and it doesn't go anywhere for 10 years, I don't love it, but at least maybe I'm getting 3, 4, 5% cash flow from it. Gold, of course, you're not getting anything. So I'm not again, I want to be very clear, I'm not anti-gold, but there is a reason why we do not have gold in our portfolios as a long-term holding. Just wanted to give you a little bit of perspective, a little bit of history, because I am literally reading an article on gold pretty much every single day. And you are as well. Up next, stick with me. I want to talk a little bit about some of the earnings reports that we've heard. Obviously, we're in the early throes of third quarter earnings season and want to just share a few with you. Back in a sec. Higher inflation and higher interest rates could be coming, but bonds are still beating stocks so far this year. How should we think about positioning for stability and cash flow in a more volatile world? Tune in every week as we discuss the latest financial trends and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. As promised, we're in the early throes of third quarter earnings reporting season. Wanted to share a few updates with you. Just remember that the names that I share are companies that we own in many of our client portfolios. And I think today, all the ones I'm going to talk about, I own personally in my own portfolio. So you should consider that a conflict of interest. If you are a client, I think you can feel comfortable. We've done our due diligence, our research, feel they're appropriate for your particular situation. If you are not a client, you really need to do your own homework because I can't manage your portfolio, through the airwaves. So with that in mind, we've heard from a few so far. We've heard from most of the banks, and I've been pretty comfortable with what I've heard. A relatively new addition to our portfolio within the past few months has been Capital One Financial. If you're here in the Northern Virginia area, D.C. metro area, you're very familiar with Capital One. They have a large presence in Tyson's Corner. Of course, going through a pretty significant merger with Discover Financial. So that's a kind of a transformational deal for them. And if you looked at their numbers, I think there was some real positives. I read a pretty nice write-up from the Deutsche Bank analyst, and he noted a better net interest margin, which is a key measure of bank, profitability. That was a lot better than expected. Also noted better credit profile. So there's been a lot of it's more than scuttlebutt, but you've started to hear more and more about bad loans that companies have, much like we've seen in other tough periods, right? Banks, private credit companies dipping their credit standards, and now that's coming home to roost. You haven't seen it much from the big banks, and Capital One actually noted better credit profile, fewer losses than was expected, and they actually had some reserves that they had earmarked to cover losses that they released back to earnings. So they felt very comfortable with that. They also noted that they're going to repurchase $16 billion worth of stock, so they're going to return a lot of money back to shareholders, and that they're sitting on almost $17 billion in excess capital. This is according to the Deutsche Bank analyst. So that was all pretty bullish. I think the more cautious side would be this integration with Discover is expensive, and they did note some synergies, right? Some longer-term cost savings. But to get to those cost savings, they need to spend some money. In fact, the CEO said, quote, "Our opportunities are many, and they are large, but so too is the investment to get there." Okay, so that's kind of I'd say that's the story on Capital One for now, is that, we have to keep an eye on the integration, make sure their costs don't overrun. Of course, there are the macro concerns about a potential downturn in the economy, right? If we start to see a real pickup in firings and unemployment, that's going to cause some angst in the banking sector, of course. But Capital One looks like they're on the right track. So consider that one. We also own Wells Fargo. They also reported. Remember the thesis behind Wells Fargo. The reason we sort of got involved in the first place is they're sort of playing catch up. If you recall, I guess it was 7 or 8 years ago, they had major governance problems. Quite frankly, there were a lot of significant systemic structural issues there that really caused the regulators to put the reins on them for a number of years, and rightly so. But those issues appear to be largely behind them. Sort of the shackles are coming off, so to speak. So Wells Fargo is allowed to do a lot more in terms of maybe releasing some capital back to their business. They can expand their balance sheet. And you're seeing that in the numbers. So the Raymond James analyst noted that after years of stagnant loan balances, the outlook for loan growth for Wells Fargo is the best that they have seen in almost a decade. That's a big deal for them. And the RJ analysts thought that their outlook for the next year is actually too conservative. So that's probably the main story there. They produced their highest sequential loan growth in the third quarter we've seen in 3 years. Also, as we saw with Capital One, much better credit loss metrics, I should say, than was expected. So in an environment where investors have been spooked about credit losses, not only from individual clients, right? Banking clients, but also bad loans. We have not seen evidence of that it has any sort of real impact on Wells Fargo. I would say the negative side of Wells is the same as Capital One, a lot of the macro concerns. Also, the valuation on Wells Fargo that was a discounted valuation has caught up to be actually a slight premium to the peer group. So I don't know that Wells Fargo is the tremendous value that it was maybe a couple years ago. But in terms of quality, I think, Wells Fargo seems to be on solid footing. So Capital One and Wells Fargo are two that I think had largely, on balance, good things to say. But, just be aware of the risks. I haven't talked about Raytheon in a long time. Raytheon is a name that earlier in the year had a really negative quarter where they really disappointed on their cash flow. And the stock took, I think it was about a 20% hit at one point earlier this year. I think you all know Raytheon. What's interesting about Raytheon is, yes, they are a significant defense contractor and considered one of the primes, but that's only a third of their business. The other 2/3 are their aerospace division and their Pratt & Whitney jet engine division. So they are arguably, maybe Boeing as well, but they are arguably the most diversified what most people consider to be defense companies. And of course, there's been a lot of macroeconomic news about the defense patch, right? There's a lot of upward momentum in the defense budget here, and also a lot of upward momentum throughout the world, right? We know that President Trump is putting a lot of pressure on NATO to expand their military budgets, and for the most part, those members are listening, and we're seeing that. And what we're so regardless of of what the tailwind is, we're really seeing that reflected in Raytheon's numbers. So for the third quarter, they beat on everything. They beat on sales, they beat on earnings, they beat on cash flow, and they raised their guidance on all three of those things for the next 12 months. So essentially, Raytheon's building momentum across all three of their segments. Often when you see one segment do well, like aerospace, maybe defense is not doing well. That's not the case right now. All three are in gear at the same time, and it's pretty clear. I mean, just to give you some perspective, if you look at their Raytheon segment and look at what's called their EBITDA guidance, earnings before interest and taxes, depreciation and amortization, their guidance is now tracking at about 17% growth year over year. Meanwhile, two of their competitors, Lockheed Martin and Northrop Grumman, on average, negative 12 to 13%. So they're outperforming in that segment by almost 30 percentage points, some of their closest peers. So pretty impressive. I'll just say I think the valuation now reflects a lot of that. That would probably be the negative story on Raytheon, right? The stock had been sort of the value name, and now it's not so much the value name. So you've got to take that into account if you're looking at Raytheon stock. And of course, they're always going to be subject to budget headlines, right? All these companies are, particularly if we get a turnover in Congress or next presidential administration. If the policies shift, that could have an impact. But Raytheon is clearly outperforming their peer group at this point. Last one I'll mention, and there are others. I know Chase will get to a bunch next week as well. I have to mention Louis Vuitton. Louis Vuitton is, of course, I think you all know Louis Vuitton. In my mind, they are the class of kind of the luxury goods business, and there are a lot of names, of course, that fall under the Louis Vuitton umbrella. Of course, their flagship business, right? But also, Christian Dior, Moet Champagne, Hennessy, a lot of others. The knock on Louis and really the luxury goods companies in general is their sales growth in the last 3 years has been anemic, and a lot of it has been attributable to China. China is the 800-pound gorilla in the luxury goods market, both domestically in China and China tourists, going to Europe and the U.S. and buying luxury goods overseas. For the first time in several years, we saw positive inflection in China demand, and again, both domestic and abroad. Secondly, Louis Vuitton has put a lot of money back into development and innovation, particularly at Christian Dior. They changed out their creative director and 3 of their main brand names, that appears to be getting traction as well. So this is a stock that traditionally had traded at a significant premium to the luxury goods space, but had traded at a discount earlier this year. The stock has responded. So again, similar to what I said about Raytheon, Capital One, Wells Fargo, the valuation now kind of reflects some of the improvement. But the way I kind of look at Louis is a little bit of a backdoor, and maybe this is a bit of a stretch, but I look at them as a little bit of a backdoor China play. In other words, if you think that China demand may improve over the next few years, rather than buying Chinese companies, which I know a lot of our clients are uncomfortable doing, maybe buying some high-quality U.S. or European brands or companies, Apple would be another one, that have exposure to those markets, those Chinese markets. That might be a more, I don't know if conservative is the right way to put it, but maybe a less kind of China-centric way to get that kind of exposure, if that makes sense. I'm going to leave it there. There are other names that I could talk about, but going forward, we're going to continue to pay a lot of attention to particularly the profit margin profile of what we're hearing and how companies are navigating tariffs. And of course, next week, we get all the big tech names reporting for the most part. So we're going to get another data point on AI demand, AI infrastructure build out, which of course has been central to the performance of the S&P 500 this year. As I mentioned earlier, please make sure you do your own homework if you're not a client. And also remember that I own these companies personally, and we own these companies for the most part across our portfolios. Consider that a conflict of interest. Hope that was helpful. And until next time, as always, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the WISE Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.